Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing ExxonMobil stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. ExxonMobil is a multinational oil and gas company. It was formed in 1999 by the merger of Exxon and Mobil. Its primary brands are Exxon, Mobil, SO, and ExxonMobil Chemical, which produces plastic, synthetic rubber, and other chemical products. The company is headquartered in Irving, Texas, and was founded in 1999. The ticker trades on the New York Stock Exchange, Deutsche Börse, Mexican Bolsa, London Stock Exchange, Zicha, Vienna, EuroTLX, Swiss, Sao Paulo, Buenos Aires, Bulgaria, Colombia, Santiago, and Lima Stock Exchange. Let's get started with the model. This is a large cap company, 436 billion market cap. They're trading at 103 a share, and they have 4.2 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow in 2019 was $5 billion. 2020 was a rough year due to COVID, negative $2.6 billion. Then it jumped way up to $36 billion, and it's even higher in the trailing 12 months, a whopping $40 billion. That's a lot of cash left over for you, the investor. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that's a similar trend as free cash flow. Positive in 2019, negative in 2020. Then it jumps way up to $24 billion, then up to $27 billion in the trailing 12 months. Revenue is a sales for the company, and that's over $300 billion in the trailing 12 months. With the higher price of oil, companies like this really benefit. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit. And that was highest in the trailing 12 months at $69 billion. Looking at numbers on a nominal basis doesn't always give you the full picture. Even though their gross profit is higher in the trailing 12 months compared to 2021, their margins are lower. Gross margin is gross profit over revenue. So they convert 22.6% of their revenue into gross profit in the trailing 12 months. In 2021, it was a little higher at 23.5%. Both those numbers are higher than 2019. And of course, 2020 was a rough year. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. An example is marketing. Gross profit minus operating expenses gives you your operating income. That was negative in 2020, highest in the trailing 12 months at $27 billion. Their operating margins are higher in the trailing 12 months compared to 2021. So their operating expenses are lower in the trailing 12 months compared to 2021. As a percent of revenue. But obviously $41.8 billion is higher than $40.9 billion on a nominal basis. A big improvement from 2019 of 5% operating margin. They paid $900 million of interest on their debt, which is a lot lower than 2020, a little lower than 2021, a bit higher than 2019. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. An example is a gain on the sale of an asset. Then you have your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which looks really good in the trailing 12 months at $26.6 billion. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit or loss. It's not actual cash. They spend lots in CapEx. They have to maintain and build out their infrastructure. They spend $14 billion in the trailing 12 months, $24 billion in 2019. Operating cash flow minus CapEx gives you your free cash flow. And they have a ton of free cash flow in the trailing 12 months. So they've been paying down debt. They paid down $23 billion in the trailing 12 months, $32 billion in 2021. But they added a lot of debt in 2020. They added $23 billion, and in 2019 they added $13 billion. They also bought back a lot of stock in the trailing 12 months, $2.2 billion. When a company buys back common stock, it decreases the shares outstanding and makes your shares more valuable. Let's look at the capital structure. $169 billion of equity, $47 billion of debt. They're 78% equity, 22% debt. Their net debt is $36 billion. And I used the middle whack on Finbox 8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $472 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $439 billion. We divide that by 4.2 billion shares. And we get a calculated stock price of 104. They're trading at 103, so it looks like they're trading at intrinsic value. Their revenue target for 2024 is $337 billion. For 2023, it's $348 billion. And with the high price of oil, it's expected to be $400 billion this year. And I continue this trend into 2025, and I got $327 billion. That's how I got their future revenue estimates. They convert on average 8% of their revenue into free cash flow, so I multiplied their future revenue estimates by 8%. That's how I got their future free cash flows. The website Simply Wall Street values the company at 110. They're saying the stock is 5.7% undervalued. So they're a little higher than me in their price target. In the last 3 months, 18 analysts priced this stock, and their price target is 101, the low is 79, the high is 120. This is where the stock has been trading the last 5 years. The 2 years before COVID, it was trading between $70 and $90. When COVID hit, it dropped to 30. I envy you if you were able to pick up the stock at 30 because you more than tripled your investment. It's close to $100 today. Brent crude is up 151% in the past 5 years. This stock is only up 21%. I'm a little surprised. I would have thought this stock would have tracked Brent crude a little closer. For about 3.5 years, it was only about 10% below Brent crude. But in the past year and a half, the gap has widened a lot. The nice thing about oil and gas stocks is you always get your consistent dividend. They raise their dividend each year. They're up to 88 cents a share. That's a 3.4% yield. Their dividend is 56% of their net income, 37% of their free cash flow, so they can easily afford it. Their dividend yield was growing steadily for about 7-8 years. Then it shot way up due to COVID because the stock price came down so much. And the dividend yield is projected to be around 3.7% for the next 3 years. The last time they did a stock split was 21 years ago, a 2-for-1. Before that, it was a 2-for-1 in 97, 87, 81, and 76. They have a beta of 1, so the stock moves with the market. It's gone up 65% in the past 52 weeks, while the S&P is down 1%. The 52-week low is 52, the high is 103. And the stock is trading well above its 50-day and 200-day moving average. Oil and gas stocks are red hot. The trading volume on this is 30 million shares a day. All the shares outstanding are on float. 57% are held by institutions, and less than 1% of the shares are shorted. If you invested $10,000 into this company 10 years ago, you would have been in the red after 8 years. But if you're still holding on, you'd be at $19,000 today. That's a 95% return, a 7% annual return. The CEO's salary is $1.6 million, and their total compensation package is $24 million. Here's a list of all the insiders selling and buying in the past 12 months. Look at all these people with sells in the 60s. I'm sure they're not happy now that the stock is over $100. But I'm sure Darren and Michael are happy that they bought in the 60s. 56% of the company is held by institutions, 43% by the general public, and only 0.1% by insiders. Their employee count has gone down a little bit the past few years. They're currently at 63,000 people. Here's a list of the top 10 biggest shareholders. Vanguard at 9%. BlackRock, State Street, Fidelity, GEO, Norges Bank, GQG, Northern Trust, BNY Mellon, and Morgan Stanley. Let's look at their financial ratios. They have a good PE at 16, that's stock price over earnings per share, better than the market median and average. A nice price to sales of 1.4, price to book of 2.6, and a really good price to free cash flow of 10.9. That's stock price over free cash flow per share. Their return on invested capital is 11%. They can easily cover their interest payments over 31 times. They have a good ROE of 16%. That's net income over equity, much better than a market median average. Their current ratio is above 1. That's current assets over current liabilities. Their quick ratio is 0.8. They generated over $40 billion of free cash flow in the trailing 12 months. They have over $5 billion of working capital. and they pay out $15 billion of dividend payments, so it looks like the company's pretty well funded. The best way to look at ratios to compare them to companies in the same industry. There are 19 companies in the same industry as Exxon, and if Exxon has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They spend a lot on CapEx, $14 billion. They have a better debt to equity ratio than average. They pay a higher dividend than the average company. They generate more free cash flow than any company on this list. They're the largest company in terms of market cap. Their price multiples are worse than average in each category. They generate more revenue than any non-Chinese company. Their 5-year annual revenue growth rate is 8%, which is lower than average. They have a good ROA of 8%, that's net income over assets, and a good ROE of 16%, that's net income over equity. So to summarize, I have them trading at a 1% discount, and you really can't lose investing long term in such a large oil and gas company, because oil and gas is probably the most important commodity out there. I'm sure we're all kicking ourselves for not putting more money into oil and gas stocks, especially now with the big bull run. But it's not too late, you could still invest in them. Although the price of oil is getting high, I wouldn't be surprised if it got even higher to $150 a barrel, but it's going to come down at some point. Just nobody knows when. I rank their free cash flows 8 out of 10, their revenue 10 out of 10, and their ratios 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.